Hello and welcome to BQ Prime. You're watching Talking Point, and my guest today is Nitin Bhasin, who is the co-head of institutional equities and head of research at Ambit Capital. Nitin, thank you very much for joining us on BQ Prime. Let me begin with the valuation 18,000 odd. And in the backdrop of nearly $30-40 billion of outflows from foreign investors, primarily being supported by domestic investors here. How do you see Nifty going into 2023?
Hi, Sajid. Thanks a lot for having me over. Pleasure to be connected. In the last 1 year, we have been using a framework to think about a fair valuation of the Nifty. And in this context, for your benefit and for listeners' benefit, that we've been using a model of earning yields differential to bond yield, and using that model along with the Nifty earnings for the next 12 months. We always had a fair valuation closer to about 18,500. So as of today, what we think is that 1 year forward for Nifty, the fair valuation is somewhere closer to 19,500, which is roughly an 8 to 10% upside from the present levels of the Nifty that we see. And that is based on two premises. One is that the government GSEC yields should roughly remain at about 7.3 to 7.4% over the next 12 months, perhaps an exit yield much closer to about 7.25 1 year out from now. And number two is the earnings. If you look at today, Nifty earnings have been very steady, very different from the last 10 years or so, where we saw frequent cuts and downgrades. So this year we're expecting closer to about 850 in FY23 and FY24. The consensus numbers are closer to about 1,000 rupees of EPS. Assuming that there could be some downgrades, the next 12-month blended Nifty EPS should be closer to somewhere, let's say perhaps 920. My mistake, 920 or so, though the consensus numbers will indicate 950 or so. So considering a small reduction, that also still makes it a 19,500 sort of a fair valuation. So which means that returns perhaps more than the GSEC that you can make. Doesn't mean that India is trading definitely very inexpensive, but yes, there is pockets to make money and perhaps a 10% sort of a upside at fair valuation.
When you talk about the Nifty valuation, Nifty number of 19,500 at the end of December 2023, do you foresee a scenario where the volatility will be there between now and next December? And while on a point-to-point basis, it will be 8 to 10% of return, but you will get much better opportunities in between?
Well, Sajid, markets are unpredictable and are actually moving more to sentiments and liquidity and flows. And this time around, it's also the global liquidity flows and even the domestic flows, which have been otherwise holding very steady. So it will be a little difficult for me to actually say, at what levels and when will it be volatile. But we saw it in the last year also, that the FI's flow for the first 6 months or 7 months, created a lot of different kind of movement than what you saw in the last 6 months. So it was a volatile year. As equity class investors, one should always be prepared for volatility. The only thing I think which could change volatility or impact volatility in the years to come are two things in the year to come. The global balance sheets of the central banks, how do they behave? Number one. And number two, the domestic equity investors which have made money, perhaps not in the last 1 year. And when you are seeing the deposit rates inch up, how do they behave to the SIP flows or to the Nifty flow or to the flows into the mutual funds? That would be perhaps another added factor to watch out for in the next 12 months compared to last 12 months, where it was very clear domestic flows were holding steady. Next year, we'll have to see how domestic flows behave when markets haven't performed in the last 1 year and the deposit rates are rising.
Your valuation theory is based on the earnings yield and the bond yield, and you're projecting an exit yield of roughly 7.25 for bonds, which basically means that at some point in time in 2023, you're going to see reversal in interest rates happening as well?
Well, it could be that the next 1 year, perhaps for a good amount of 9-10 months, the interest rates continue to rise, because we still believe that the repo should actually be increased by at least 25 bips in this cycle, or perhaps 35 bips but 25 bips is what we believe for sure, which would also mean that there would be pressure on the rates to remain at a higher level. But for the yields to cross a 7.5 or a 7.6%, the market has to lose confidence on the fiscal deficit. We believe that the fiscal deficit will be closer to 6.8% as compared to the budgeted 6.4%. At the same point in time, you are seeing reasonably good collection. So in the taxation for FY24, I would say you wouldn't have much of a problem that the interest rates shoot up massively. But hence, I'm more like in the camp of interest rates perhaps rising only marginally from here. And perhaps if we see a downward, I don't see it before CY24 if it has to happen, not in CY23. Perhaps marginal movements towards the end of the year.
So it's basically you're saying that, the next one we may see a 25 bips increase, and then there is a pause for a while before it reverses. The question is that whether that pause will be long enough or it will be a short duration pause, and what are the factors that will determine that pause, because your yield will move accordingly, right?
So we have noticed this, that if you plot the last 20 years of repo to yield, the gaps are much higher between the GSEC and the repo at the beginning of the rate hike cycle. But when the repo starts reaching closer to the peaks of, let's say, we believe 6.5 is the peak, you need not be necessarily at a differential to the median differential of 99 bips or an average differential of 110 bips. It can perhaps reduce the gap between. So you can very well have delayed repo cuts 1 year out, and perhaps the rates or the GSEC move much before. So we are believing that a median 99-100 bips differential, perhaps towards the end of the year or middle point of the year, just looks like a 75 or a 65 gap between the repo and the GSEC. But yes, as our country is going through multiple resets in terms of, we have a current account deficit issue also, perhaps we also have issues around jobs, how the government goes out and supports job creation. Perhaps they are the only one carrying the mantle of capex in India, and the global recession impacts the exports growth from India. Those are the few macro factors which can play spoil sport to what we are thinking, which is a more normal economic scenario rather than concerning or a worrying economic scenario.
It's interesting that you touched upon the deficits, the twin deficit. We already have a fiscal one, and we have a balance of trade deficit, which may also come in. My point is that if that deficit continues, what is your view on companies which are majorly dependent on exports? Do you see export-oriented companies and companies with large revenue coming from exports faring well in going to 2023, or they will have a challenging task?
Well, I wouldn't be in the right position right now to talk about the exporting companies because perhaps it is a function of, let's say, which are the largest exporting companies in India. It is IT sector or pharma sector right now. And then perhaps we're looking at chemicals also. It could be that, or for that matter, electronics is coming up as the fourth new promising sector over here. IT sector may actually face some pressures from the recession in the US, but perhaps that is already in the price. In the last 1 year, you've already seen closer to a 40% sort of a underperformance to the overall market. Pharma, is perhaps also going through some bit of good patches and the not so good patches. Chemicals clearly, but they have to still expand and invest a lot of money, and the valuations of the chemical companies are not particularly inexpensive. And electronics is yet to begin because the PLIs, etc., have yet to be rolled out in the manufacturing exports. So there could be far and few examples that they do very well in the exporting from India. But just to form a view that should we be buying exporters or should we be shunning exporters, I wouldn't want to go there, because as I would want to share is that IT is a sector where we were massively recommending an underweight in the portfolio for the last 1 year. Today we see, given the relative underperformance, one should be actually reducing that underweight materially for the institutional investors, and be more closer to the equal weights on Nifty or Nifty 100 for that matter. Why? We are what because perhaps the valuations, relative performance, under ownership, or the earnings estimates revision downwards has stopped or is marginally left out there. So sometimes, Sajid, but many a times in the markets, stocks behave very differently to the fundamentals of near term, and 1 year can be a short duration as well. Earnings can be earnings growth, stock performance can diverge for a period of 6 to 12 months, and perhaps that's why not here to stereotype whether we should be buying or shunning exporters altogether.
So do you see IT outperforming the index here, and they've been underperforming the index by 40 odd percent? Many of the top companies at least.
So if you look at the last 1 year, since the time we've been writing about the markets for about last 12 months or so, what we've been highlighting to the investors is that the two clear sectors where we could give out calls was that banking sector is something which should be a very good outperformer, and IT sector should be a very strong underperformer in the year of CY22. Those calls alongside perhaps worked out, but the biggest surprise was also an FMCG sector doing perhaps the second or the third best sector last year, along with the PSU banks. Where are we today, right now? I think the relative underperformance of IT sector, which touched closer to about 38 or 40% on a last 12-month basis, which is very similar to the points that we have seen in the history in the last 15 or 20 years in India. Whenever a particular sector, especially IT, when it touches such rough points of performance, relative underperformance, it over the next 12 months lands up giving a reasonably good returns. I know as fundamental analysts might not be able to connect to this, but the way we look at it is that in markets, sometimes fundamentals versus the flows versus the valuations, they can all move separately. So hence today, we think that given the earnings estimates revisions downwards have nearly stopped in the September quarter, number one. Number two, relative massively underperformance. And the third factor is a relative under ownership amongst most of the mutual fund investors in India. About a month back when we were checking, the reasonably large funds were underweight on IT as low as about 300 bips to about 600 bips. So as you go into the next year, what we are recommending is we should reduce that and become more like equal weight in IT sector.
How do you play out maybe PSU banks or banking sector, BFSI as a whole? Because PSU banks were clearly something which no one expected, but they outperformed everyone. And now the valuation gap between PSU and private is narrowing a bit.
Fair point. So, about 1 year back, why were we long on banks at that point in time? A point of view was that if you were to look at the correlation between the real yields in India and the bank Nifty over to Nifty, there's a very strong positive correlation. And hence, if the real yields are rising, it's the right time to actually go out and get long on the banks. That was one reason. And again, the same point that I was mentioning to you about a relative underperformance, banks were actually gone through a massive underperformance also roughly 1 year back. And that has played out. And a similar model, like an earning yields and bond yield, if you were to use on a book yield to the bond yield, it gave you a clear fair valuation upside of anything between 16 to 18% for the bank sector. So hence, for that reason, we were long on banks. But today, where we are sitting after a reasonably good performance of PSU banks, more so in the bank Nifty, we think that there is 1 or 2 quarters more left of bank outperformance. Should one be massively overweight? I don't think so. And hence, what we are suggesting to the investors is you should be reducing your reasonably high overweights if you were carrying. Even if I talk to my banking analyst right now, what we get a sense is perhaps first half of FY23 was a period where you saw a very high NI NIMs for the banks, closer to 3.5% for 11, 12 banks, which includes SBI also, but not the PSU banks perhaps. They've gone through a lot of repricing on the MCI on the repo rate linked or the external benchmark linked rates. But PSU banks still have some room left because of the either A, liquidity, or B, for the kind of repricings that they can take for the loans that they have lent out. So PSU banks could show good numbers for the December quarter as well as for the March quarter. But for overall as a banking sector, I doubt if the overall NIMs for the next year, which is FY24, should be anyways higher than the 3.5% that we saw in the first half of FY23. So not a very highly, overweight recommendation over here, but more like a marginal overweight right now. The real question will arise towards the middle of the year, that what would investors do if they have to rotate out of banks, but they have to maintain their BFSI overall weights? Which subsector of the BFSI you should be actually in? But today, sitting here, clearly some of the regional banks and the PSU banks score well on liquidity and the margin sustenance for the next 2 quarters.
So what about the other sectors? You spoke about FMCG was a surprise. It became the second most performing sector in this year. We've seen some kind of demand sluggishness coming in rural, and everyone is talking about that. It's the rural engine. It needs to start so that the demand and volume growth comes back. FMCG has been able to pass on some of the price hikes to whether in form of grammage or in terms of actual price. But do you see that outperformance sustaining in FY23 or calendar year 23 for FMCG and consumer goods?
Well, last year's performance was a surprising performance as one of the best sectors after PSU banks. I think today, sitting here right now, I think we don't see signs of a rural economy actually becoming any better, at least for the next 6 months or 9 months. Negative real wage growth, that is one of the key things that you see. Perhaps not enough jobs getting created for them to leave the cities, for them to leave the rural farmland and go to the cities, etc. So we are not very gung-ho about the rural, and you can see that in the behavior of many FMCG companies. Even unlisted companies like Parle are talking about more premium biscuit launches, which clearly shows that most of the FMCGs are all banking on premium products and trying to capture always the upper 5%, 10% of the consumers of that particular category. So given that sort of a view, and today that we don't see a major income change for the middle or the bottom of the pyramid, I wouldn't be going out and betting my money on consumption, especially FMCG, or even for that matter, auto right now, where we see whether it is two-wheelers or whether it is four-wheelers, we see the stocks trading very expensive right now. They've had a very good run for the last 1 or 2 years, and the valuations look very punchy right now. So auto wouldn't be the space that one should be overweight either on going into the next calendar year, perhaps. We recently came out with a report also on Maruti Suzuki, where we recommended a sell right now for reasons as that, you're seeing still the demand of the premium products. They're going to perhaps launch products in the hybrid where they will compete with Toyota. So multiple factors like that. And even in the two-wheeler space also, we don't see the reason to turn or remain positive right now. On the other hand, if I was to say that how to look at the markets, perhaps stocks which have not performed or the sectors which have not performed, let's say an oil and gas, where marketing margins might look much better in the next year. The valuations are reasonably not so expensive as compared to many other companies. And hence, you would have that sector as one of the key sectors alongside, as we said, ID equal weight or a bank's marginally overweight. Perhaps I would not shy away to say oil and gas should be an overweight sector as we go into the next year.
Nitin, one of the segments that people talk about is mid caps and large caps. We see we discuss a lot about large caps because they're part of the indices, so we do look at them very closely. But mid caps is something which is a space which not looked very closely, but there's a lot of liquidity which is there in that segment, and a lot of uh, new companies which are coming in are forming part of that. How do you what is the house view for you with respect to large caps and mid caps and asset allocation when it comes to them?
Sure. So Sujit, again, similar to the sectoral calls for the last 1 year or so, what we have been recommending to the investors is that in times where we are not seeing a fair valuation upside to the Nifty more than between 6% and 9%, today closer to about 9% or so, we would want investors to consider investing or staying overweight in the large caps. When I say large caps and mid caps and small caps, we're still trying to use the terminology given by AMFI, the top 100, the next 150, and the next 250 stocks. So for that matter, what we are noticing is that today investors should be more overweight on large caps compared to mid caps or small caps. And why do we say so? Historically, we have always spoken about good quality companies, return on capital employed. But as followers of the market and understanding where the value creation comes from, one of the things to assess that is return on invested capital less the cost of capital, which is WACC for the sectors. If you look at the last 15 or 20 years, today, the return on invested capital less WACC for mid caps is one of the best ever on a median basis compared to, let's say, even the large cap companies. But it has only happened in the COVID years of FY21 and FY22, which has led to a lot of optimism visible in their valuations. And we're not talking about price to earning or price to book. We're talking about much more real valuations like enterprise value to invested capital. They are trading at a material premium to themselves in the history and a material premium to the large caps. So we find that this valuation excess is because of the higher spreads, which are a function of margins, which are very high, or reinvestment rates, which are very low. So we find that the mid caps today are enjoying high ROICs for high margins as well as low reinvestment rates. This has to be in revert. If they have to grow, they have to invest either in working capital or gross block assets for that matter. That's number one. Number two is you will have inflated commodity prices. They'll have to go out and seek growth in different price points products. So hence, you will have to go out and compromise on EBIT margins perhaps. So we have FY23 and FY24 earnings downgrades, but more importantly, a little bit more compression on the cash flow generation, which would cause the valuations come under pressure. But that's one side from the valuation. The other aspect is if you look at the markets today, on the earnings downgrades, look at the Nifty 200 for FY23 EPS. Nifty 50 would have gone through just a 4% estimate downgrades. But a Nifty 200 would have gone down by about 8.5 to 9% earnings downgrades, which means that outside Nifty, there is more pain on the earnings right now. So hence, that's from the downgrades. And the number three is, if you look at our proprietary model, which is the greed and fear index that we have built, that is based on the overall value participation on a daily basis in the market. We simply look at the market's value traded every day for Nifty 100 and outside Nifty 100. Today, we see signs of greed in the market. A lot of value participation on a daily basis is happening in the mid-cap companies. So you've got excessive activity in the outside Nifty 100, but earnings pressure building outside Nifty, and the valuation is trading very high. So a perfect three forces that we see, which could create pressure on the performance of mid caps in the year to come by. And I don't think the small cap could be anything different from that. So hence, we've been advising that one should be very, very wary about investing in mid caps right now. Not to take away the point, Sajid, that mid cap companies go on to become multi-baggers or large caps. But we have seen that in the last IPO cycle of 3 years, hundreds of companies have got listed, and a number of them are small cap and mid cap. Not all of them have actually succeeded in creating wealth also. So hence one should be treading that with a little bit of a caution, especially today when valuations are very high and the downgrade risks are looming large.
So we do one look for alpha, because you do recommend to your institutional investors, and they would be having the same question that where do I get the alpha from if I have to be uh, limited to my large cap and my returns are going to be in line with the index. How do I generate that alpha?
So as we discussed, perhaps an equal weight to IT, an overweight to OMCs, an overweight to banks for the time being. And definitely this year is going to be another difficult year, perhaps if the last one was also, and it will be a stock pickers market. And what we are seeing in the last 1 or 2 years, sector rotations continue, and that will perhaps continue in the next year also. So, no clear answer. We should want to look for alpha. But as I said, these are 2 or 3 sectors one should be looking at, and these are the 2 or 3 sectors one should be avoiding. We have learned over the years that one should be investing in good quality companies alongside reasonable valuations, because even the good quality companies or very good quality companies can sometimes trade at very expensive valuations, which by itself can create a drag for the 1 year performance. If it also depends upon, Sajid, what is the horizon of the investing or the investor. If somebody is thinking of 5 years, 1 year, and 2 years, our recommendations are more based for our institutional clients investing for the next 12 months.
Next 12 months, you said?
Yeah.
Okay. My final question to you is on the government's budget coming. I mean, we spoke about the deficits and challenges briefly. Going into an election year, what could be the kind of focus for the government, given that there is a constraint with respect to revenue generation? Tax collections have been robust, but the inflationary impact or the interest rate impact may have an impact going into FY24 for them. So in all those scenarios, where do you see the government putting the focus on?
I think clearly this government for the last 1 or 2 years has shown to us that they are ready to pick up the mantle for capex in India, where the large corporates or the private sector capex remains less than what one desires right now. The government is busy building infrastructure, and I think we need that. This happened in the Northeast, and we need a lot more before the private sector comes and builds businesses on top of that. So when we look at the budget, though my economist is yet to come out with his pre-budget note, when we look at the upcoming budget, we think clearly you will see a lot of harping and talking about capex. I think they should be looking at least 20 to 25% capex growth. I think revex will become even more important. They will have, that will be the tough one to manage. Why? Because you still have to support a lot of people with food subsidy, with a lot of people with, let's say, a fertilizer subsidy, and at the same point in time, the economy, I doubt if can grow at about 8% in FY24. We are more closer to about 6.5% or 7% estimates for next year. So hence, because you also have a global likely recession, which also has an impact on India, how much it can grow. So in that sort of a context, I would say one should be thinking more about watching out for 2 or 3 things. One is that what do they give out as a budget deficit, which is always the case. But you will see a lot of discussions around capex and revex. They can't pull back on revex, given that the union elections are just about, say, 15 to 18 months away from now. So that's the limited views on the upcoming budget.
Nitin, it's been a pleasure talking to you today. Thank you very much for joining us on BQ Prime.
Thanks, Aziz. Pleasure speaking to you.
And wish you a very happy new year as well.
Same to you and to the viewers. Thank you.